Good morning, everyone. I'm John Amodio. I'm the chairman of SCORE on Staten Island. I want to welcome you and on behalf of Richmond County Savings Bank, SCORE Staten Island, Doreen M. and Sarah CPA, PC, and the Independent Association of Accountants of Staten Island. We have this webinar today that is dealing with the smart ways to deal with bankers and understanding financial statements. There are a few things that you need to know about what's going on today. Number one is that your line will be muted. You get this slideshow on the road here.
The bottom of your
Okay.
screen should have like a sorter, John.
All of a sudden we have a problem here.
I think if you double click it from the beginning, it will it should
It said slideshow resumes, slideshow on that top left.
There we go.
Okay.
All right. I'm sorry for that, but we're very pleased to have Richmond County Savings Bank as our main sponsor. They're the ones that are helping us with the financing to do this. I'm very thankful to have Doreen and Sarah involved to provide the CPE or CE credits for those who want them, and to have the Independent Association of Accountants also participate. They have been very helpful in putting things together for us today. As I said earlier, your line is being muted. I'd like you to please use your Q&A versus chat if you have any questions. A copy of the slides and the recording will be sent to all the attendees. At the end of the session, there will be a brief survey that will be sent to you. There'll be actually two of them. The first one that will be coming will be an evaluation form to be completed by people who want CE or CPE credits. The second one is the one that everyone who asks for a free presentation can fill out and send back to us. There will be 6 keywords that are going to be presented during the session. You will need to enter those keywords on the evaluation form if you are looking for the CPE or CE credits. A little further information: the course numbers for the CPE and CE credits will be on the evaluation form that you receive, so that you could keep a record of it. And they are also listed at the top of this page that you're looking at, page number 2. As I said before, I'm John Amodio. I'm chairman of SCORE. I have been in the banking business for most of my career, but I am also a CPA and have had, I guess I tease a lot, but I've retired 3 times, and I keep getting called back, and I'm very pleased to be working with SCORE, providing guidance to small businesses here on Staten Island. In addition, we have Frank DeCandido, who's with us today. He's a CPA. He's got his MBA. He's also a certified financial planner. And he also has been a teacher, a professor at Wagner College, who I think you'll find quite interesting when he makes his presentation concerning the financial statements. Both of our bios are included in the slides that you're going to receive. Let me start by talking about smart ways to deal with a banker. You know, bankers are individuals and banks are individual. So each is a little different, and you need to get to know a little about the institution or the banker in order to get the best results. First of all, just keep in mind that the bank is not an investor. They are not your partner. They're a lender. They're here to help you with the loans that you might need, but they are not to be considered a partner for you. One of the important things that you need to do is, you know, don't arrive late when you go to a meeting. It is also unforgivable, as far as I can say, to arrive without the required information in hand. You don't need to waste your time, and you don't need to waste the banker's time by going there and saying, you know, I just want to find out what you guys are doing. You need to get that information some other fashion other than at the time you're going to request a loan. Never expect the loan to be granted immediately. The bank has its processing to go through. If you expect the money quickly, the bank will consider you as being a poor planner. That's part of their evaluation of who you are and how good you're going to be in following through with the loan once they give you one. Be prepared with the financial specifics of your company's operations. You don't want to say, I'll have to go and check that out. You should know what's going on in your company. And if you have financial statements that are being presented, you should know what's in those financial statements and not say, oh, I got to ask my accountant. I got to check with him first or her first. You should know your numbers so that you can show them that you have control over your company and over your operations. Don't compromise on your loan request. Know how much you need. Stick to it. Think about how you're going to pay it back. If, for example, you need the money for a year, then look to work on something for a year. Don't let them talk you into doing something for 30 years. If you need money for 3 years, don't accept that they will want you to pay them back within a year. You know, you have to live by it, so don't compromise on your loan request in that fashion. Don't be naive. No standard loan terms. Become familiar with the things that they're pretty standard and pretty simple for you to know. For example, You should know the amount that you want to borrow. You should know the cost of money. You should know what collateral you have available to give in connection with a loan. And you have to understand repayment terms, what they might be. So
John, at this juncture, I'm going to throw out a keyword now for them
okay,
to write down, if that's okay.
sure.
So the key word, since we're speaking about loans, is loan. L-O-A-N, loan. So just jot that down because you'll need to put that on your survey when you submit it back to get credit. And after this, there'll be 5 more keywords. So that in total, there'll be 6 keywords. All right, I'm going to leave you with loan. Thank you.
Thank you. By the way, that was Doreen and Sarah. She's the one who's making it possible for us to provide CE and CPE credits today. All right, the next thing that you have is don't misuse the proceeds. Besides the obvious violations in a loan agreement, your word and character are immediately in question if you misuse the funds. Your character and word are your bond, and they are very important in making sure that everything is okay as you're going along with the bank. Communicate and live up to your commitments. If at the beginning you promise to provide certain data, make sure you provide that data. Make sure you deliver the information that you say you're going to deliver at the time you say you're going to deliver it. When you do go at the beginning of looking for the loan, you will be bringing some information with you. I'll go over that in a little bit. But it's your way and their way of knowing what's going on with you and the loan request that you have. Structure your capital needs properly. If you need 3-year money, don't settle for repayments in 6 months. If your banker wants you to make the loan for only 6 months, that's fine. But put them on notice that it will have to be refinanced at that time. Again, you're building your credibility with the banker that you know what you need and you're going to use when you want it. What I'm going to do is I see we're getting some questions. What I'm going to do is I'm going to handle the questions at the end, if that's all right. And if it isn't, that's what we're going to do anyway. So don't forget about the bank's other services. The bank is going to want you to put your checking account with them, with other things, your online services, computer. They want you to be a part of them, and they want to know that you're dealing with them. So make use of their other services. It doesn't mean you have to use them exclusively, but make them your primary bank. There's going to be some negative covenants that you're going to find in the agreements that you're not going to like. Please don't look to chop away at every one of them. They don't like to be chopped away at. The banker is working with a document that has been reviewed by attorneys, sworn to up and down that this is what they have to get. But the ones that you definitely cannot live by, those are the ones that you need to try to negotiate and say to them, I can't do this one. I can't live with this one for whatever reason. It shows professionalism on your part and gives you more latitude to fight for the more major issues, not everyone that's there. Know how the bank makes its final decision. The bank, you're talking to a lender, and in some places, the amount of the loan that you're looking for, the banker can make the decision on the spot, or by himself or herself. Others are going to go to a committee. Others are going to go up further than first committee to a second committee. It's never really immediately on the spot. So just understand how it's going to be, so you don't wind up getting frustrated when you see that, hey, how long is it going to take before I get a decision from you guys? And don't prepare overly optimistic projections. You should be preparing projections that you feel are going to work. These are things you're going to learn to live with and live by. So you could have the worst case scenario, best case scenario. When you're looking for the amount of funds that you want to borrow, base it on your worst case scenario, if I could put it that way. Lastly, really, just remember to communicate, communicate, communicate. Bankers dislike surprises. What I've done here is I've just summarized what I've given you, what I've said before. I'll just run down it quickly. You will have this so that you could refer to it as when you're ready to go look for a loan. The bank is not an investor. Don't arrive without required info in hand. Never expect a loan to be granted immediately. Be prepared with financial specifics of your company's operations. Don't compromise your loan request. Don't be naive. No standard loan terms. Don't misuse the proceeds. Communicate and live up to your commitments. Structure your capital needs properly. Don't forget about the bank's other services. Negative covenants, don't negotiate each one. Know how a bank makes its final decision. And don't prepare overly optimistic projections. Let me take this opportunity for a moment to see what questions are here so I could maybe answer some for you. Okay, this is a question for Doreen. We'll answer that later. All right. Every banker winds up using the 6 C's of credit. Some will say there's only 5, but there are really 6 of them out there that you should be aware of. First of all, they want to know about your character. They want to know your trustworthiness. They want to know your personal and business credit history, that you have integrity, They want to look at the quality of your references that they're going to ask for. They want to know your experience in business and the impression you make on the lender or the investor. So be prepared when you walk in that you look presentable. If you need your accountant or some advisor to go with you, take them with you. Make that part of the presentation that you have when you walk in. Your capacity. They want to know your ability to repay the amount that you're borrowing. How soon can you generate positive cash flow? Remember, they don't expect you to make a profit in the first year. But they do expect that you will start getting some type of a cash flow coming in, and your projections will help you to determine that. When will you start showing a profit? How large will the profit be? And whether the profit can be sustained. You know, in your capacity, they're interested in knowing primarily that you can pay them back and that you could live off the business. So in your projections, that's part of what you're going to be trying to figure out and present to them. And they will then look to you to see that you are able to accomplish that. If you find that you're not able to do that, remember, keep them involved, keep them informed, let them know that things are not going the way they were going to go. For example, if you borrow the money prior to the pandemic, I'll use that as an example, and then the pandemic came along, it's obvious that they know that you're not going to be able to meet the requirements as you did before. But let them know that you know, and that you're keeping them informed. They want to know about capital. The money you have personally invested, your ability to save money and accumulate growth in owner's equity. They want to know that you're putting your money into the game. Remember, they're not investors. They're looking to make sure you've got money into the deal. That's why they usually say, hey, we won't lend you more than, 80%, or they want you to put some money down. But they want to make sure that you've got money in the deal. If you're not willing to put money into the deal, if you're not willing to put collateral up, then they're saying, why do you want us to do it if you're not willing to put your own funds at risk?
So
You're going to
John,
know what
John,
yes.
at this juncture, sorry to interrupt you.
Go ahead.
We're going to do the next keyword, which you said it a couple of times, and it's very important, is collateral. The second
Okay, thank you.
word, please write that down.
Okay,
There are a
collateral,
total of 6
everyone.
words, collateral. Okay. Thank you, John.
Okay. Now, what is collateral? Okay. This is their secondary source of repayment. It's a third party. It could be a third party guarantee, a tangible assets that you have, property, equipment, accounts receivable, inventory. All of these are different types of collateral, and it all depends on the type of loan that you're looking for. If you're looking for a real estate loan, a mortgage, they're going to be looking for property as collateral. If you're looking for an accounts receivable financing, naturally they want to see what your accounts receivable are. If you need money for inventory, they're going to make sure that they're going to take a lien against that inventory. So the collateral becomes very important The bank, most banks, in fact, I don't know of any that are going to take it without you giving your personal guarantee on a loan. And then the conditions. This is the terms of the loan, including the intended purpose, the amount requested, the length of the loan, local economic clients, local economic climate in the industry, as well as in the business. They're going to do an industry study. They're going to do it. They're going to do a study of the type of business that you have, and they're going to look to compare you against other businesses of a similar nature to see how your projections, how your income looks compared to other businesses, and depending upon conditions at the time, they will weigh each one of them and make sure that you're falling into the average of what people are, or what's out there in conditions. And the last of the C's is the cash flow. Where the money to repay the debt will come from, and how the proceeds will be used. So they want to know, when they give you the money, how are you going to use it? Am I going to buy inventory? Am I going to be buying a piece of real estate? Am I going to be using it as working capital to pay employee salaries? And then, of course, how are you going to repay the debt? They're going to look to see, is it coming from sales? Is it coming from winning the lottery? How do you expect to repay the debt? So again, these 6 C's are included in the slide presentations that you will receive. And let me move on now to the cover letter. When you go to meet with the banker, this is basically where you're going to start. You're going to have a cover letter or the equivalent. And in that cover letter, you're going to have the amount of the loan. You're going to state who's borrowing the money and how much you're asking for. Is the money in the name of a corporation, in a partnership, in your personal name? And the amount of the loan is, the dollars that you're asking for. They're going to know the purpose of you're going to tell them the purpose of the loan. It could be one of several of the following. It could be for building, construction, real estate, conversion or expansion, investment in equity and equipment and facilities, machinery, or it could be working capital. But you're going to state what you need the money for. What's the purpose of the loan? Actually, it's a lot of the things that I just said before, and when you're dealing with the banker, but you're going to summarize it for them in a cover letter. You're going to have a definition and description of your business. You're going to state in simple terms what your business is. If you have a sales brochure or some article that's written about you or describing your business, this would be useful to bring this along and make it part of the package. They're going to want to know your background. They want to make sure that you or some key managers know the business, because they want to make sure that you could run the business and know what you're doing, so that the business has a good chance of surviving and succeeding. You're going to have to point out here what personal investment that you have in there, and make sure you point out that besides the money that you're putting into the business, that there's a lot of time that you've put into the business in in making things work. For example, if there's improvements that you put into the place, you know, how much of those improvements are you doing yourself? If you're being your own bookkeeper, for example, how much time are you putting in for that? And if not, what key people do you have that are working with you? What accountants are you using? What attorney are you using? These are going to be all important things that they need to know, and you need to know. You need, before you walk in and say, well, now I got to go find my attorney and just see who I'm going to use, and ask them, who do they recommend? You should have that beforehand. This is where a SCORE may be able to help you. And in fact, in everything in this letter that's needed, the SCORE could help you put it together and make a good showing when you go in to meet with a banker. The business objective and strategies. State what you want to achieve, your sales and profit, how you plan to achieve it. Try to do this for at least a 2-year period. And your financial condition. Summarize your balance sheet and profit and loss statement for at least 3 years. Also specify your current loans outstanding, including any lenders that you have, loan descriptions that you might have, loans out there, payments made, and the amounts due. The bank people say, well, you know, I think I could go for an SBA loan. And if I go for an SBA loan, it's a little easier. Well, an SBA loan is the information you need to provide for an SBA loan is the same information that a banker is going to ask you for. Basically, they're looking for a business plan. The information that is shown here in the cover letter is the information that would be in a business plan. So if you haven't put a business plan together, I suggest that you have one, because it will answer all of the questions that the banker will probably want to know. And it not only will answer the questions that the banker would want to know, it'll answer the questions that you need to know in order to run your business. With this cover letter that I'm talking about here, you're going to have some attachments. You're going to have a balance sheet of your business. You're going to have profit and loss statement of the business. You're going to put in your projected income and expenses, and you should have at least 1 year, hopefully 2 years of projections that will help you. Your cash flow projections, and they're going to want your current personal financial statement, and they're going to want your federal tax returns. Most of the time, they would like to have the last 2 years, sometimes 3 years of tax returns. This is generally the package that you're going to walk in with when you go to meet with your banker. The financial statements that I mentioned here, Frank is going to address them in a few minutes. But let me say, are there any questions that anybody has at this point in time that they want to bring up?
John, can I make a comment?
Sure can.
Okay, just want you to clarify. Many times business owners do not realize that working capital is defined as current assets less current liabilities. Simply that. That's how they determine their working capital. When they go in for a loan, they go higher than what they have in working capital. So could you just kind of dealing with that in your area, Have you seen that to be a weakness in these businesses? And the balance sheet is so important compared to the profit and loss. I mean, they're both very important, but that's where they get their working capital number. So if you could just comment on that.
Sure. Working capital is something that you will come up with to help you in startup. How much money do you need in startup? In putting together a business plan, you're going to say, this is my startup numbers, and I need this to pay my security deposit for rent. I need this to pay my employees before I open the doors. I need it for insurance that I need to pay to cover me, because the insurance you're going to pay up front as opposed to paying it in installments later on. So that's all funds that you're going to need. And that's all going to be part of what's going to be your working capital that you need. In addition, as you start working, you're going to start seeing that you have in your projections, you're going to see that you're not making money every month. You're going to have a shortfall. And that shortfall, again, is going to be made up by funds you're going to borrow, and that will be considered part of the working capital that you need. So when you're going to ask for the money of working capital, they're going to look at your projections, cash flow projections, startup costs, and you should be looking at, where is that working capital coming from? Is it coming from my pocket? Is it coming from a relative that's going to be giving me a gift? Is it going to be coming from monies that I'm going to be borrowing from the bank? But that all becomes part of your working capital, and the working capital winds up being on your balance sheet, in a sense, in the form of cash, inventory, prepaid expenses, so to say, and the like. So you need to put together these numbers, and if you're not familiar with how to do this, you should be working with an accountant, CPA, to help you. Now, SCORE has available a number of templates that you could use. These templates will help you to put together your projections. They'll give you the ability to do some what if scenarios. What if I sell 100 widgets? How much money am I able to make? What if I sell only 50? What happens to me? What if my employees, if I have 6 employees and versus my having 10 employees, and other items that could be the what ifs. The main thing when you're looking at some of this stuff, these numbers and projections as you're dealing with the bank, is you need to know your numbers. You need to know your numbers. Remember, you need to know your numbers. People say, in my projections, I'm going to show a 10% increase in sales every year. Okay. What does 10% increase in sales every year mean? Does that mean you need to get another 100 customers every year to meet that need? If you've only gotten, if you don't think you could get 100 customers every year, then 10% is not the number to use. So need to know your numbers and you need to know that you could live with those numbers. The projections you put together are going to be most useful to you. And you could work again with the accountants to help you with that. And as I said, SCORE has some templates that you could use. They'll work off of Excel. And you could put in these numbers and it'll give you the what ifs, and it'll help to create not only the cash flow statement, but it'll also help you to prepare your cash flow statement, your balance sheet, and your income and expense statement. These analysis, these templates will also help you to come up with some ratios that are important. All of these are going to be discussed shortly by Frank, and there are tools out there to help you, and don't be afraid to use them. At this point in time, what I'd like to do is maybe take a 5-minute break. Let's see, any more questions that anybody has at this point?
Well, John, I figure while they're jotting down their questions, we are going to do one more keyword before Frank starts, and he's going to talk a lot about it.
Okay.
So we already did loan and collateral. The next important keyword is revenue. And you talked a lot about that with sales, right? So revenue is the next keyword. Jot it down while we go into the break. We have 3 more keywords coming up. And how much of a break are we taking, John?
I just take a 5-minute break.
All right. Thank you very much, Leonard. Appreciate it. Good morning, everybody. I'm going to piggyback on a bunch of things that John had mentioned about financial statements. And the one thing I can tell you is the fact that, as John had mentioned, it's all decision making. We'll talk about external and internal users of those financial statements, and there are a lot. But when you talk about decision making, you got to be careful with just taking financial statements by itself. There are a lot of estimates when it comes to financial statements. Depreciation life, the inventory method that you're using, accounts receivable, accounts payable, those are all estimates that are in financials. So just taking the financials, if you get one thing out of this, is there's a whole bunch of other things that need to be incorporated with that. Tax returns, John had mentioned at the end there with his presentation. I don't even think banks are taking regular tax returns anymore. I think they're going to the IRS and getting transcripts, because tax returns could be fraudulently done as well. So also with the working capital, you're just looking at your current assets and current liabilities. And we'll get into what's involved with current assets and current liabilities, but it depends on what current assets you have. There are good ones like cash and investments, and then there are not so good ones. Inventory could be valued a different way. If you have a large amount of accounts receivable, that is also a red flag. So there's a lot to it. There's financials, there's the notes of the financials, there's the ratios that come in at the end. But we're going to go through all of that. When it comes to who uses the financials, there's generally 2 sections. There's external and internal. And when we talk about external financial statement users, we're looking at people that do not run the company. So it says, I'll go through a couple right here. When we're talking about external users, board of directors, if you're a customer and you want to do work with that company, if you're a supplier and you're going to supply material to that company, obviously the independent auditor, board of directors, those are all the external, what we call external users of the company, of the financial statements. The one there that's interesting is the non-executive employees. And those are, again, people that, are looking to look at the financial statements to see maybe this company is doing way better than my manager told me. And, I want maybe a bigger raise than what they're giving me. We had that at Prudential a couple of times where they would tell that there was only a 2% increase, and so we couldn't get a raise. And then we would find out that the company was doing a lot better than we thought. So in that part of external users are the people that are not specifically running the company. And those would include some of your employees who would want to know how the company is doing. Internal are all, again, the managers of the company that want to know how the company is doing, what their own numbers are. With my experience, I worked at Prudential for about 18 years. And when I first started, I did a daily profit and loss statement. So all of the different departments of Prudential Securities at that time, you had capital markets, you had retail, international, investment banking. They would all give me information on what happened on a daily basis. I would then estimate some expenses and, give this financial report out. George Ball, who was the chief executive officer at the time, he wanted it on his desk the next morning at 6 o'clock when he walked in. So now this is 1987, 88, 89. And there was not one thing on the desk called a computer. So you had to physically walk to the other buildings and put these on each of the managers' desks. But they were important. George Ball would look at it. He would look at it from the day before, see if there's any changes, and make phone calls at like 6:10. And so all these other managers who were also looking at this report had to have answers for him when they were looking at this report. So there are internal users that need to look at the financial statements, and those are some of them. That may not be all of them, but that's almost an exclusive list. I generally bring this up. We have, with the New York State Society, we have a couple of programs that we run, one for high school, one for college. And we go over all the opportunities that we have in accounting, financial, managerial, taxation, and accounting related, such as forensic accounting, business valuations. But I always go through this because there are so many different types of accounting opportunities, career opportunities that you can have in the industry. And we're fortunate because there's a lot of things that we can do. And I try to get the high school and college students to understand that, they're getting into a great area for a career. This is really not a job. It's certainly not 9 to 5, as everyone knows, but there are a lot of opportunities in accounting that will produce the opportunity to create financial statements. And so I just wanted to list those out here. So as for the financial statements themselves, I'm going to go through 4 of them. The income statement is the profit and loss. That is where your revenue and expenses come into play. Could be a net income or net loss. And again, not necessarily would you just automatically look at a net loss and say that the company's not doing well. Again, you have to look at the individual categories and see what is going on with the company. Statement of owner's equity is just a change in the capital. And the one thing that you really should know here is that when you're looking at a financial statement, one of the, I'm just going to say negatives of the statement is the fact that the equity section, or even the change in net assets for a nonprofit, those are book value. All right. It does not reflect anything having to do with the market value of the company. That is a whole different, I mentioned business valuations. That is a whole different presentation. But you're looking at the capital balance here. That is the book value of the company. And that'll lead us to the balance sheet, which I think Doreen had mentioned may be as important than the other two. To me, it is, because you have to have your balances at the end of the year correct. And the change in those assets and liabilities are going to affect the income statement. Again, one negative here when you're looking at a balance sheet, to take the cash position, inventory position, liabilities, you're looking at one day in time, December 31st, June 30th, whatever your year end is. So you have to take that into consideration as well. They could be showing assets on December 31st of $1 million, but over the next couple of days into January, there may be big bills that they held off on that are now going to lower their cash balance significantly. So just keep in mind that with the balance sheet, you need to look at several years, but you are looking at one day in time here. And then to me, even more important than the owner's equity or the income statement is the cash flow statement. And we'll go through what's involved with the cash flow. But I have a couple of companies where I look at where the cash flow is coming from. And if you look at the financing section, for example, and you see a big contribution by the owner, and that is more than what the increase is in the cash flow from year to year, that would be, to me, a red flag in looking at the cash flow. If the owner has to continue to put money into the company, and that is what's propping up the company, that's a big red flag. So there are things on the cash flow statement that are really important. And again, without a proper cash flow, you generally don't have, your company is not going to last very long. Doreen, do we have any questions? I can take them as we go along. If not, I'll just continue.
I do not see any questions at this time.
All right, cool.
Okay.
All right, so your income statement, which is a description of your revenues and expenses, will give you an indication operating wise, how the company is doing. Your revenues, again, as John mentioned, can come from several different areas. You certainly want this to be a positive number, which means from just an operating standpoint, no money coming in from the owner, which is going to show up on the cash flow. It's also going to show up on the statement of owner's equity. Your operating revenue is there. If it's more than your operating expenses, that is where you want the company to be. You could have some items where there's a large amount, maybe that they made an investment in the company, and that added to the depreciation, which added to your expenses. And this is where you would look at the depreciation, going higher from year to year. You would look at your cash flow statement, and then it would show, hey, you made an investment in machinery or some type of other equipment that maybe for the short term is going to increase or decrease the cash flow, increase the expenses because of depreciation. But over the long term, they're going to need that machinery. They have a lot of more orders coming in. They need to increase their inventory, and so the cost of goods sold is going to be higher because they know that they have things coming up that's going to increase their revenue. So like I said, taking just a negative net loss on its face is something that you shouldn't do. It should be reviewed in conjunction with the other financial statements. The other thing that I did mention was the footnotes, which if you have an audited financial statements, you would also have footnotes to the financials. Those are going to be obviously very important to look at as well. If they did buy that machinery, it's going to show what they did in the footnotes to the financial statements. When it comes to operating expenses, again, salaries are going to probably be the biggest, rent, office expenses. You can look at the categories, and if you see other, and that's a large number, then that means they're trying to probably hide something. When I was in auditing, if you saw 0 as well, and they show that on the financials, or you looked at the general ledger and you saw 0, you should click on it just to see if there's any, a lot of information going back and forth that creates that 0. That means that they're starting to move stuff around. So there's a lot of detailed look at the general ledger when it comes to both revenue and expenses. Any questions on that?
So
Yep.
Frank, on the tax side of it, the financial statements are becoming more and more, and you're going to talk about it in corresponding between with audits. If there
Right.
is applicable financial statements issued by the company, they have to provide that during an examination. And if there is these issues you're talking about, this is where they can kind of dig deeper into the details. If you just want to comment on that.
That's absolutely correct. I mean, I do a lot, most of my work is in taxation, individual, and I have about 92 companies. The companies, before the tax return is done, the financial statements have to be done. I don't have a lot of financial statements that have to be audited because I have a bunch of smaller companies, but they have to provide to me a bank reconciliation. If they're looking at AR, what the aging of the AR is as well is very important. If you have even if it's a medium-sized AR, if most of it is over 90 days, then you have an issue with issue with the company. But every tax return that I do, if I'm doing it for a company, preceding me starting is a financial statement. I have a couple of the high schools out here in Staten Island. We have to provide audits. Those have to get done before we move forward. All right.
And AR, just to, to
Yeah.
define as accounts receivable for those that just need.
Accounts receivable, yes.
And
Right.
that's what we talked about, working capital, which is your current assets, accounts receivable minus your current liabilities. Is
Yeah.
an
And if
example
that,
of
if that number is high, then that, even though it's an asset and it shows ownership, if you have high accounts receivable, even high inventory would indicate that maybe they're not able to sell their products. Those are the two indicators that even though they're on the asset side and the working capital is going to be positive, you could have a possible problem. A high accounts receivable could mean that they're doing a lot of sales too. So you just have to delve down into the detail. There's two sets of companies, service companies and merchandisers. You're going to see that their income statement is going to be slightly different. With a service company, we talk about accountants and lawyers. We talk about hotels, airlines, where you don't have inventory. Those would just be a regular standard revenue less expense would equal your net income and loss. If you have a merchandiser, Best Buy, Target, any department store where you have inventory, then you have an expense called cost of goods sold. And I kind of listed on the bottom how you get to the ending inventory, but those two, the cost of goods sold and ending inventory, could be intertwined, interchanged. And you're looking at inventory plus the purchases, gives you merchandise available for sale. To get to ending inventory, you would minus cost of goods sold. But to get to cost of goods sold, you would be, and you have to, minus ending inventory. So that's just a twist when you have a merchandising company that has inventory and, again, cost of goods sold. You don't, when you have inventory that becomes an asset, the only time that inventory would become an expense called cost of goods sold is when that inventory is sold. So this, just to point out, there's two different types of income statements, for one for service or one for merchandise. Oops. Statement of owner's equity. Again, you're looking at the book value This explains the change in the equity from the beginning to the end. You have your contributions in there. If it's dividends for a public company, that would be a deduction. An S corporation or a partnership is able to contribute, and then you have withdrawals, which a partner or a shareholder is able to do within S corp. You have to be careful about one thing. If you have withdrawals and you have owners that want to withdraw from the partnership or from the S corporation, if it creates a negative capital, then you're going to have a capital gain. So when you try to explain this to clients, their capital, the basis of their shares, which has become a big item for the IRS with this form 7204. You have the changes includes net income. If it's a plus, an income, a loss would be a minus. You have owner investments in the company, which would be positives, and then withdrawals such as just plain withdrawals on an S corp, or in the case of a public company, you would have dividends would be a deduction from the
Frank, just going to clarify 7203.
7203.
Yes. And I think we might for SCORE be able to do a presentation on some slides on that for the tax update.
Yeah, we need to do that because a couple of the Staten Island chapter members were asking about that as well as other items. So that'll be a good topic. All right. And again, this is what I had described before, the pluses and minuses of getting to the capital balance. Again, if you see a big withdrawal, that may mean that the owner may be trying to bail out, or they, again, pluses and minuses. On the minus side, they may be able to getting out of the company. They want to withdraw the money. But on the plus side, if they're withdrawing it and they're using it to maybe buy something that the company is going to need, then that would be, that would be a positive there. So again, the cash flow statement would also have this information involved in it. So you have to look at all the other financial statements, not just the one. And as Doreen had mentioned, to me, one of the more important financial statements is the balance sheet. We'll get into the details on that. Again, just keep in mind that you're looking at one day in time. You're taking a snapshot of the assets, the liabilities, the equity as of one day, and that is really needs to be taken with a grain of salt. But things can happen right after that. You really just have to look at the financials with the other financial statements involved as well.
And that's why the bank would ask for comparatives, I would expect.
Agreed. Public companies, they're giving you 2 years. There's also information in the MD&A that would give you 5 years of information. So again, it's tough. Some people, you got to be careful with companies that want to make sure that year-end balance sheet looks good. They will put AR on there where they don't have a sale. They may not put an accounts payable that needed to be there because the expense was incurred. You would hope that the auditor would pick that up, but on private companies, you may not have an audit. So you guys got to be very careful. All right. So when we talk about assets, we talk about ownership. Basically, it's broken up into a couple of different categories. Current, long-term. There are some financial statements that break out intangible assets, and I'll get to those in a second. But when you're looking at the asset side, and when we talked about working capital before, the current assets is one half of that equation. And I put some of them listed on here. Obviously, that's not everything that you could possibly have. Short-term marketable securities, cash, checking, CDs. When we talk about marketable securities, we're talking about money market instruments. If the company owns common stock of another company, A lot of public companies will own common stock of competitors just so they can be involved with the getting the financial statements, even though if you go to if you have a public company and you wanted to dig into their financials, the SEC site, Securities and Exchange Commission, sec.gov, all you need to do is put in the symbol and you'll get the quarterly statements, the 10Qs. You'll get the annual statements, which is a 10K, which is a long, lengthy report that'll give you just about everything you'd need for the company. And then there's other reports in there. 8A is another type of report where if there's a certain effect on the company, they may have up as little as 5 days of putting the information out. So if the chief executive officer of the company is resigning, that has to be told to the public within, I think it's within a couple of days, if not 1 day. Other things can take a little longer, but the SEC.gov site would be where you would look to get information on public companies. Accounts receivable, again, these are things that are owed to you. Again, important on the accounts receivable, as I mentioned before, you need to look at, and banks will ask for it as well as lenders, the aging of the accounts receivable. So generally, you're going to break it up between current things that are within 30 days. You'll have 30 to 60, 60 to 90, and then over 90 days. If you have an accounts receivable where that over 90-day number makes up the bulk of the AR, then that's something to question to the management as to why those things are out there. Eventually, the problem with accounts receivable that's old, it has to be written off, and then you got to realize that there's going to be expenses put on the books, bad debt. So the accounts receivable is really important to dive down on. Same thing with the aging of inventories. If you have inventory for 90 days, 120 days, that means that the company is not turning things over. And that would be another question for management as to why that is happening. You'll see that listed out on the, obviously the inventory, but then you'll see probably your sales decreasing. And that's an indication as to this may be something wrong with the company. Maybe they've had some issue with, again, we've had supply chains issues. Maybe they're not getting it out to where they need to get to.
So Frank, before you pass this slide,
Yeah.
I just want to do the next keyword.
Okay.
And it's a current asset. It's cash. Very popular word, right? Cash. So jot that down. We have 2 more keywords after that. There's a total of 6. You'll need 6 keywords. So the next one is cash. Thank you very much, Frank.
Thanks, Doreen. Obviously the cash number, that number, you should see that and agree with that on the cash flow statement. So and that's going to have to agree, and we'll get to the cash flow statement in a little bit. But as obviously everybody knows, cash is king, and you have to have it. Cash flow statement is going to show you whether your cash is coming from operations, which is what you want to see, or it's coming from some other. If it's coming from a big loan that they got, or it's coming from the owner, then that's a red flag for the company. On the long-term side, generally we'll look at everything that's over a year. You got the long-term marketable securities. If you have a treasury bill that's 5-year, it's going to be on the long-term side. Your property, plant, and equipment, net of accumulated depreciation, is going to be shown on the long-term side of the aisle. And again, this is where the comparative would be important. If they've taken cash out, maybe the cash is low, but they've invested in either a machine or some type of equipment, and you see that increase from year to year, that's going to be where that flow of cash would be. It's also going to be reflected on the cash flow statement. That's going to be a question for management as to why they did it. But if their feeling is that, look, they need to expand, maybe they want to open up a new branch, they want to open up another store somewhere, they need the equipment. These are all positive things for the company. Land I put in separately, just keep in mind, land is not depreciated. So you're gonna have property, plant, and equipment that's gonna be depreciated over its useful life. Generally, that is known when you buy the, obviously you have to know that when you buy the equipment. But land is generally not depreciated. If we look at something like goodwill, that is when you buy another company and you've paid more than the book value. And there's certain rules as to how long you have to depreciate or amortize goodwill. Intangible assets could be vitally important to the company. You're talking about patents, copyrights. If they have a lot of copyrights, that means that they're going to be in good shape going forward. Especially when I went over this with students, someone like Michael Jackson had copyright on all his music. Sometimes those things last 99 years. They're the only ones that everybody that uses that song has to pay the Jackson estate. So those are important. Coca-Cola, the sign, the McDonald's insignia. These are things that songs, books that we use at Wagner. They all had copyrights where I could not take that book, use it for my own purpose, and make money off it. Or take copies of it. So that's an important section to look at, the intangible assets section, including goodwill and the intangible assets. Important section to look at to see what the goodwill, the company is going to have these assets for a very long time and be able to get the benefit from them. Any other questions on that?
No
Okay.
questions at this time.
Okay. I've either put people to sleep or I'm really good. I don't know which one is. Okay.
Great stuff.
Yeah. I'm trying to get down here. Let's see. Balance sheet. Oops. Okay. When we get to the liability side, you have the assets, that's fine. But to me, one of the best indicators of how the company is going to do on a long-term basis is to look at their liabilities. Debt to me is kind of a four-letter word. I prefer that debt to equity ratio is going to be fairly low. The current ratio, current assets divided by current liabilities, I want that to be higher. But liabilities are things that you owe. Accounts payable, and again, with accounts payable, the same way that you had with accounts receivable, there's an aging factor here. If you're looking at a company's accounts payable, and a lot of it is more than 120 days, then you're getting an indication that this company is not able to pay their debts on time. And that's a pretty big red flag for the company. Get rid of that. Accrued expenses, you could have salaries that you accrue. There's utility bills, other things that, again, when they're incurred, if they're incurred in the month of December, but they're not payable until early January, the fact that they've been incurred means that on a GAAP basis, that belongs on the financial statements. So with assets, or revenue, it's when it's earned. With expenses, it's when it's being incurred. And so, those accrued expenses, you would hope that a company, if they have these type of things in the bills due in January and their income is kind of low, that they're pushing the expense off to next year. You got to be careful about that. Auditors will look at, the first maybe 30 days, 45 days of the next year and look at what's been paid. If those expenses were incurred in the year before, then you're going to have adjustments. And that's one of the more important audit steps that they can take, is look to see whether everything that's been earned is in revenue and has been incurred is in the expenses. Deferred revenue is the opposite, where you've received it, but you have not earned it yet. And again, this is another area where you can possibly have some fraud, because if you collect some funds in, the end of December, and again, depending on where you are, the accountant looks at it and goes, you know what, we're kind of low on the net income side. The money that came in, I'm just going to leave it as, somebody could have made a down payment. It happens with construction companies. If that money doesn't belong in December, it belongs in January, February, whenever that work has been done. So you got to be careful with deferred revenue. If you see a lot of deferred revenue, you can, certainly take a look at it and make sure that it's correct.
And you see this in a lot with not-for-profits. I think they.
Yep. I have it with my high schools. We start collecting tuition in August. The year end is August 31st. That income belongs in September, when, over the course of the year, when those kids are attending school. So absolutely. And then the current portion of long-term debt. If you have a mortgage that's 15 years, the first next 12 months of payments needs to be in the current liability section. When on the right side, when I talk about long-term debt, that long-term debt number is everything over 1 year. So years 2 through 15, if it's a new mortgage, that will be on the long-term debt section. And the same thing with deferred revenue. If you're collecting now for something that's going to happen more than a year from now, then that is an indication that it should be in the long-term liability section.
Frank, I have a question.
Yeah.
From Shalom Solomon, CPA. Red flag, is accounts receivable and accounts payable over 90 days or over 120 days?
90 days to me is should be the mark. Certainly if it's over 180, then you're really in flaming red area. But I would be concerned if it was over 90 days. I do a lot of smaller companies, and again, the high schools. If it takes a company more than 90 days, the only way I would have something over 90 days if it was something that was in dispute. 90 days to me would be a big red flag. Same thing. All right.
Thank you. That's it.
Okay. But that whole, again, when you look at accounts receivable, accounts payable, asking, for that aging schedule is going to be really important. And when we talk about, I did assets already, liabilities. Okay. The equity of the company, again, on the increasing side, you have net income, you have contributions. If common stock is issued in a public company, or additional paid-in capital would generally mean that you issued stock over its par value. Those are all the increases on the equity section. And on the decreases, you have net loss, you have withdrawals if you have an S corp or a partnership, or a sole proprietor, and then dividends issued if you have a public company. As I mentioned before, the equity number is a number as of the snapshot at the end of the year. Just because it's plus or minus, you got to dig into the detail, and just keep in mind that it is the book value of the company. If this company is looking to sell the company, or if you have a buyer, you certainly want to look at the financials, but there's going to have to be another analysis, especially if you're selling the company. You want to know what the market value of that company is. There'll be another analysis that does that calculation of the equity, the market value of the company. There are no mark-to-market adjustments on a financial statement. So, I find this with some nonprofits where they have investments. The unrealized gain is put off on a separate Schedule D. But when you're looking at 990, for example, the unrealized part is not going to be reflected there. So it's the same with the regular financial statement, the mark to market. They can have stock, that common stock issued is going to be at par value until it's sold. It could be $1. But the value of that stock could be $100. That will not be reflected on the balance sheet. May be reflected in the notes to the financials, which you'll have to look at, but it will not be part of the net worth of the business. We're talking about book value here, not market value.
Frank, before
Yes.
you go to the next slide, so net income with the Inflation Reduction Act. I believe it's for $1 billion or more.
Okay.
There's going to be a tax. We're going to talk about that in the tax update, but this is why it's important to know the financial statements, in this case for the larger companies, but also for the small, because if they have an applicable financial statement, that could be used as well. But
Yes.
it's becoming more and more where they're merging financial statements and tax.
Yeah, and you're also looking at the PPP loans, which came in the last couple of years. That increased cash flow. If you had a PPP loan of 500,000 and your cash flow, went up by 300,000, that's a red flag that the company was struggling, and they needed that money to stay afloat. So taxes are huge. You're not going to see it on the tax part of it, but certainly on the financial statements, things like that, the one-time issues, we're coming into play now with the EIDL loans. Those are things that should be highlighted, and certainly the manager of the company should, be able to explain. All right, statement of cash flow, that's the fourth, and I put those in order, by the way, the income statement, then the equity, then the balance sheet. And I did that going back to my Wagner days to explain. I remember being on the blackboards doing the income statement. The net income then flows to the equity section, and then there's another arrow going from the equity section into the balance sheet. So that was my teacher mentality in putting him in the order that I did. But the statement of cash flow is another very, very important financial statement. As we know, that cash is king. You have a couple of different sections. You have the operating section, you have the financing section, and you have the investing section. Each one of those areas will pick off different areas of the balance sheet. And then you'll have your non-cash items as well. But that identifies, as I say here, the receipts and outlays. And you can see that they need to be pretty detailed in where all the outlays are. If, again, an owner is withdrawing money, that's going to be a separate line on the financial statements. If they got a PPP loan, that's going to be a separate line. The change in the accounts receivable, change in liabilities are going to be in the operating section of the cash flow statement. The starting point, obviously, is the net income. And as I mentioned before, you have things like depreciation methods, change in inventory, that estimates that are in that net income item. So the net income really doesn't tell you the whole story, but the cash flow is going to be a big part of the financial statements that you're going to be looking at. So let me get down to that. Sorry about that. Okay. So here we have the cash in the beginning of the year. Towards the bottom, you're going to have the cash at the beginning of the year and then the cash at the end. In the middle, you have plus and minus operating activities, which are basically your current assets and current liabilities. Your investing activities, which are basically your long-term assets. And then your financing activities, which is your long-term debt. So the changes in those numbers are going to be what ends up on the statement of cash flow. And again, if you don't have cash flow in a company and it's not coming from operating, it's very, very difficult to continue to run a business. If the owner has to put in money, if they're taking loans from a bank constantly year after year, and those are increasing, very difficult to run an organization. All right. And these are just the operating activities, some of the inflows and outflows that you'll see. Obviously, it's not all inclusive, but again, you're looking at the current assets, current liabilities of the cash flow. So again, when you start with net income, a couple of things are going to be added even before you get to operating. You have to add back depreciation because it's a non-cash item. And there's a couple others that off the top of my head I'm trying to think of, but depreciation is one of the major ones that you're going to have to add back. You're going to be looking at the current asset, current liability section when it comes to the operating section of the cash flow. All right, investing section, cash inflows and outflows. If you're selling property, you're selling long-term investments, you're selling short-term investments, that could be another indication as to maybe there's an issue, especially if you have to sell off your property, plant, and equipment. If you have a company that's growing, they really shouldn't be in the business of selling off their their equipment. They could be selling it because maybe it's old. Again, you'd have to dive into the details. But if they're collecting principal on notes receivable, you got discounting of notes, all these are part of your inflows of on the long-term asset side. On the outflow side, and again, it could be a very big positive for the company, especially if they're buying property, if they're buying intangible assets, if they're buying long-term investments. That means that there's a long-term view from the company that is a positive. And again, that's something that should be collaborated with the notes to the financials as to why they're doing it. But these are kind of things that you can highlight and say, all right, why are we doing it, and getting the manager, president of the company to tell you, why we're doing these items. But that is the investing side of the cash flow statement. All right. Something like that. Lord.
I think you're on 43.
43. I'm trying to get there. Okay. Long term, when it comes to financing, inflows and outflows, issuing stock, which is a positive. Even the issuing of debt. If you feel that the company doesn't have enough cash, but on a long-term basis, you need money to buy equipment and to buy other assets. If you don't have stock to issue, then you could issue long-term debt. Issuing treasury stock is when you're issuing your own stock. And then the contribution from owner, that's where I would have a red flag on the financing activity section. If that contribution from owner, again, year after year after year is a big number, then you need to make sure that you get some type of analysis from the owner or the president for why that's happening. The cash outflows, you're paying dividends. Paying dividends is actually a good thing. Then again, thinking long term, you wanting to keep your shareholders happy, you want to pay dividends. Paying owners, withdrawals to owners, not so much. Again, depending on what that owner wants to do. And then a positive would be paying off those debts, which means that you have some extra cash flow and you want to put it back into the company by lowering your liabilities, especially if they're long term. Also, the conversation comes in with interest rates. Interest rates are going up right now. You want to pay down, bonds that maybe have a very high interest rate, and leave the ones that are, if you're going to pay out interest, you want that to be lower. That can always be a positive thing if you have extra money to do so. Right. Any other questions on that? Maureen, we're good?
no questions. When you get to the tax side of it.
Yeah.
We will have our next keyword.
Okay.
We have 2 more keywords to fit in.
Okay. There are some non-cash items that usually below the ending cash balance, you'll have some footnotes on non-cash items. Some of it is if you issue stock and then turn around and bought equipment. I've seen that a lot where the company needs to get cash, they issue stock, they turn around, they take that money and they buy equipment. There is no cash, general cash effect, zero net, but they'll have to explain it when they get to the bottom. So I just wanted to put some of these down here. Trigger finger. Okay. All right. As Doreen had mentioned, and she was spot on, that you do a tax return, and the first thing you want to see is the financial statements. There are going to be some differences between the financial statements and the tax returns. The first one is whether you're on accrual basis and the tax returns on a cash basis, which you can do. Accrual basis, especially for public companies, it has to be on an accrual basis for GAAP. But you have the ability to do the cash basis for tax returns if you decide to do that. We'll talk about temporary and permanent differences that are going to be on these financial statements between the tax return. You could have different depreciation methods. We know that for depreciation on the tax return is a section 179. In 2022, you're allowed, depending on the asset, and I don't want to turn this into a tax course, but if it's equipment, you could depreciate and accelerate up to $1,080,000 of depreciation. Not allowed to do that on the financial statements. That's going to create a temporary difference, something that's going to turn around in the later years when you're 13, 14 years into the asset and there's no depreciation on the return, but you're still depreciating it on the financial statements. Same thing with inventory methods. We have FIFO and LIFO. We have weighted average. You can choose to use those different methods on the return compared to the financial statements.
So we're just going to do the next keyword.
Yep.
And you said it a couple of times, and many of us know it. It's depreciation. So jot that down. We have 1 more to go.
Okay.
Depreciation. And Frank is going to talk about it, I think, quite frequently now.
Okay.
Thank you.
So when we talk about depreciation methods on the financial statements, there's a couple that you can use. Straight line, obviously, you're taking the number, dividing by the number of years. Double declining is you're doubling up. You have to look at the book value, and you're taking the straight line and timesing it by 2. And that's on the book value that's left over from the year before. And then with production companies, you could use units of production where you're estimating what the depreciation is per total units that is produced by that machine. And then each year you're taking that per unit item and you're timesing it by that units of production that was done for that particular year. Those are the methods that you can use on the financial statements. And again, if you have a different method on the tax return, that is going to create temporary differences. You want to use on a tax return the accelerated method as much as possible. Again, you can't create, a loss with that, but if you have a large income, I do a lot of tax planning with some of the smaller S corporations towards, October, November. We look at their financials, and if they're high, and the net income is high, we want to go out, we want to buy that truck, we want to buy that equipment that they're going to need later on, but you're able to take a tax deduction for that full amount for the taxes. You're able to take a full deduction in the year that you buy the truck, and you can write it off. Whereas on the financial statements, you're going to straight line that truck over whatever it is, 5 to 7 years. So these are the methods you could use on the financial statements, but just know that there's different methods that you can use on the tax return. And I'm going over here some of the methods, straight line, how to calculate it, double declining balance in the units of production. Many companies, like I said, use the accumulated depreciation. If if they have gains, that will lower their taxes. And obviously that's the whole point of doing tax planning with clients. And again, you're using both the financials, using the financials first, and then you're looking at the tax return and, how could we bring the tax down? And that's many companies will agree to use that accelerated depreciation. Again, it's got to be a decision made because you're not going to have that in year 2, year 3, year 4, up to 15 of that asset. But knowing that the next year comes along, you probably have, if you're in the same position, maybe they need another truck or maybe you need another piece of equipment. So on a year-to-year basis, to me, anytime you could defer taxes, that's what you want to do.
So Frank, just a comment, many businesses and clients and maybe some practitioners don't realize, but the balance sheet on the tax returns, the corporate tax returns, if you're required to prepare it, is the book basis.
Yeah.
Right? Not the tax basis. And
Yes.
that's where you do those reconciliations on the M1 and M2. Thank you.
Correct. Again, hopefully we'll do a tax, off of this, we could do a tax CP somewhere down the road. All right. For tax purposes there's a couple of methods. If you bought an asset before 1987, you're still on the old acres, but now after 87 going forward, it's the modified accelerated cost recovery system. Section 179 is what I just mentioned that allows you to accelerate the depreciation. And again, in 2022, on certain assets, not every asset is eligible, but you can deduct up to $1,080,000 in depreciation for your taxes. Give me 1 second. And that's the section 179 asset that we just section 179 method of depreciation that we just discussed. By having these different by having these different methods for the tax return to financial statements, that creates both, generally would create for the depreciation would create temporary differences. You do have permanent differences, and I'll get into those in a second. But there are things like municipal interest, for example, will be an income on the financial statements. You will never see it on the tax return as income. So, apologies. So these are the types of things that are considered permanent. Meals and entertainment's another thing, depending on, if you used a restaurant or did not. 50% of the amount could be deducted on the tax return, up to 100 on the tax return, but then you're taking the full deduction on the financial statements. When it comes to temporary differences, we talked about depreciation. That's going to create temporary differences from year to year. Again, if you're using the accelerated method of depreciation, you're going to have a higher expense on the tax return, and then that's going to turn around in the rest of the years on the financial statements. Inventory, same thing. If you're using first in, first out on the financial statements, but for some reason you're using maybe weighted average or last in, first out on the tax return, that will create temporary differences between the tax return and the financial statements. And those different methods will create either deferred taxes or an asset or a liability, depending on whether the accounting income is higher or lower. And I don't want to get too much in the weeds here, but you can see, I gave this just as a demonstration. But those are generally current on the financial statements, depending how long the difference goes on for. But generally from year to year, you're going to have deferred tax assets and liabilities because you have these different methods of depreciation and inventory. And that's the two inventory methods that I mentioned. The one thing I missed here is also a weighted average that you can use every time you buy something. You can take the average of what everything else was before that and use that going forward. That's a calculation that would be done through some type of Excel spreadsheet. And then other important things that you can have that you're going to have to look at is the notes to the financial statements. Again, will tell you a pretty important story as to what you need to look at. It'll further explain things that are on the other financial statements. Break-even analysis, I'm not going to go crazy with, but there's a couple of things that you can use, especially when you have inventory, to know how many do I have to sell just to break even. Basically, you're looking at your fixed costs and you divide it by your unit costs, and it gives you an idea. I got to sell 3,000 widgets to break even. If we know, financial manager will be able to look at it and say, hey, if we're at 4,000, we know we have net income. That will create other decisions based upon whether you make the break-even analysis or not. And then with benchmarking and financial ratios, again, I didn't get too much into this, but there's liquidity, there's profitability, there's solvency, there's market prospects. Those are the four major areas that you can look at. That will be a great tool when you want to get indications of what red flags are. So sometimes market analysts will look at and say, your current ratio needs to be X. And if it doesn't make that, if your profit margin is not a certain amount, then your stock can take a hit. But those benchmarking and financial tools are great. They're great internal tools for managers, CEOs, CFOs to know how the company's doing, and then they're going to have to explain it to the public and their shareholders. So it kind of gives them an idea of what's coming up. I remember at Prudential when we went public, we would be on the calls that the managers, the CFO would make to the brokers, because then the brokers would have to then explain why their company's stock went down, by 5-10%. They would have to explain that to the shareholders. So it was interesting to go through that process. And that's all I have, unless there's some other questions.
And that's why it's also important for them to understand their financial statements when they're dealing with the banker, right, John? So I'm
Yes.
going to do the last keyword before you do your closures, and then just ask one question to Frank.
Okay.
So the last keyword is inventory. Frank talked about it on slide 55. That's inventory. So with that, Frank, I know inventory is a big topic. Can you think of a scenario when you had a client just come to you and say, okay, look, I want to sell my business? What issues came to mind? They just decided it was going to happen now with regards to inventory or the way their balance sheet looked. Just a couple of comments about that.
I would tell you, what I had said before was, the same way you have AR and AL, accounts receivable, the liabilities, accounts payable, you have an aging schedule. You're going to have the same thing with inventory. The one thing I would do if it's an inventory company, I would have them show me the logs of the inventory. I'd like to know that the company, the product that the company is selling is moving the inventory. There's probably a financial tool for that as well. But it will tell you whether inventory is moving. Days in inventory, I think, is the financial tool. If you have inventory that's not selling and sitting on the shelf, as a buyer, that's going to be a little bit of a red flag as to what is the scenario that the CEO, CFO act to explain why that inventory that was bought, 30 days ago, 45 days ago has not been sold yet. So as a buyer as a seller of a company, you want to make sure that your days in sales and inventory, that they're low. But as a buyer, you want to see those logs. You want to see when inventory was bought, when it was sold, and the turnaround time, because that's going to indicate whether the product that they have is moving. And of course, as you sell inventory, you have revenue, and that's where the business has to be valued at.
Thank you.
All right.
I want to take this opportunity to thank Frank for his presentation. It is, as you can see, there's a lot of complexities in financial statements, but every business, even the smallest of businesses, even personally, you wind up putting together a balance sheet, an income statement, and even some projections that you need. I wind up having myself just putting together at the end of each year a balance sheet and an income statement of what happened for the year that I use for preparing my taxes. And I try to put together a budget for the next year so I know where am I going to get my money from to live and try to make it, for the year. So these statements are things that you could use in your personal life as well as in your business life. As I mentioned earlier, there are some templates that are available on the score, and they could help you with your statements. I also want to thank Doreen, one, for helping to sponsor this. Number two, for stepping in today and helping us with the keywords and questions that came up. She's a lifesaver in her way. Thank you so much, Doreen. And
You're welcome, and thank you both. That was fantastic, Frank.
Yeah. And John, one thing I would throw out to you, when one of the areas I was at at Prudential, we were e-business development group. It was when the internet was really starting up. When you go in, you probably have mentioned it, but it's to have a business plan would really be important. When vendors came to us and they wanted them to be on our website, the basic is, all right, you're going to have, we could put out, a web page. You need to know how many people click on it. You need to know how many people then go to the website. You need all the way to how many people are actually buying the product. And that number, you could have 1,000 clicks on that website. You may get 1 or 2 people buying. So the business plan, the business template is really important. And as for the financial statements, the accountant that you have, the CPA, if you're looking to sell or make a loan, they should be looking at the financial statements of the company even before you approach a bank. They're probably going to give you some insight whether you're going to have a problem or not. So they're the first person I would call.
thank you. Frank, could you forward it to the last slide for a moment? Okay. This subject is far from being entertaining, so to say, or exciting. I know I find it difficult to speak with this because as an Italian, I'm not using my hands. And I prefer doing these webinars live, rather workshops live, as opposed to doing webinars. But it's a thing that we have now, the thing that we're trying to live with and work with. And there's so much more information available these days that we need to learn how to use it, including, as Frank mentioned earlier, when I go back in my day, you would always look to get the tax returns. And now the bankers have available the ability to request a tax return. They ask you to sign an affidavit or some type of form saying you're allowing them to go to the IRS directly to get your tax returns. So things have changed and they continue to evolve but the basics are always there. You need to deal with people. You need to deal with a banker. You need to deal with your professionals, your accountant, your attorneys, we at SCORE, you could work with us too as advisors to help you with things. So at this point, I just want to say thank you, and I'll say thank you to all of you for participating and hanging in there during this whole session. Thank you so much. Hope to see you at our next one is coming up in October, which is October 27th. And you'll see flyers that are coming out to tell you about that October 27th, the webinar. Thank you so much, everyone.
Thank you for having me, John, and also thank you to Frank in both your presentations. This will be a resource to me going forward. The 6 C's of credit and understanding financial statements. Thank you so much.
My pleasure.
You're welcome.
Take care.
Goodbye.